Hey guys, welcome back to another video. Today we're going to be talking about the top 10 red flags to look out for when buying a business. And this specifically relates to small businesses and lower mid-market businesses. And it doesn't really involve the actual risk analysis of that specific industry. It relates more to the structure of the business and how that company is set up. So, what are they? The first is right out the gate, and this is so frequent, the key owner involvement. If the owner and shareholder of that company works 90 hours a week in the company and wears multiple hats and really does the job of four people, that's a key risk that needs to be addressed. The second one is poor financial controls and records around tracking monthly financials, about doing inventory counts, about paying bills on time and collecting receivables. The third is deferring investment in equipment, facilities, and staff. And that largely means the owner may be very old and doesn't want to put in more money into the company to replace key capital equipment or make the investment to replace the roof in the facility that the business is in, or invest in training staff so that they're properly equipped to run the business without the owner there. The fourth is environmental. It is really a very common one you see with manufacturing companies and something that needs to be addressed. The fifth is family members and related parties. And what that means is either the family members of the shareholder are in the company holding key roles within the business and how that impacts the transition, or family members that own customers, suppliers, competitors to this company in the sector. And obviously, if the brother or the uncle owns a supplier and now that shareholder sells the company, how does that impact the performance of the business moving forward? So that's something to look out for. The sixth is customer and supplier concentration. Very common, you'll see across a lot of lower mid-market businesses where a customer will make up 20, 25% of the business. What does that have to do? How does that impact the company? The seventh is non-compete and non-disclosure agreements, especially in a service-based businesses or a business where there's some key technical piece of knowledge that results in the company being competitive, generating the profit that it does. You have to ask yourself, the employees that are there that are going to stay on post sale of the business, do they have A, non-disclosure agreements that protect the IP of the company? And B, do they have non-competes? Because what if you buy the business and the next day the key staff that own the formula, that know the formula, leave and start up a company and there's no agreements in place to protect against that? So that's another red flag you got to look out for. The eighth is employee turnover and compensation. You always want to make sure that you ask for an employee list to see how they're compensated, whether they're grossly overpaid or underpaid, and how has employee turnover been in the last 3 years to see just the general morale of the company from the outside looking in. Because you'll never know until you own the company, but you can look at that employee list and see, wow, like 40% of the staff leaves almost every year. Either this owner's a tyrant or the company is just a loser, and the morale is very low. Now, the ninth one is declining financial performance, something more specific, but I'm going to drill into the specific areas of the financial statements that you got to look for. And the last one, the 10th, is an expiring real estate lease. And what this typically does is whenever there's a business that's tied to a piece of property or that owns a manufacturing facility, and if that business doesn't own the property and they're subject to a lease, expiring leases, the term of that lease is essential. Because what happens if the real estate owner sells a property to someone else and kicks you out of there? Can you move the business? How much is it going to cost to move the business? That's a risk that you need to be aware of. So before I jump into the specifics of each of those 10 points, I'll rather drill into managing this risk because all acquisitions carry some sort of risk, and investors have to look to manage that risk rather than avoid it. I hate whenever I talk to potential buyers with regards to my own engagements, and they say, well, that business is risky. No. Every business is risky. But the difference is that you can structure away risk. And if you're willing to structure it away, then you can look at any business so long as obviously you start pulling on these levers. So these red flags are mitigated by pulling the various levers to structure the right offer to match the risk level with your risk appetite. And so there are 4 key levers that you can pull. The first and the most obvious one is a purchase price. Obviously, if the business carries a significant amount of risk, there's environmental damage, or there's a upcoming expiration of a real estate lease, and you're going to have to move the business. That's a ton of risk. That's a ton of future costs that you have to incur. So you're not going to pay as much. So higher risk equals lower value. The second one is deferring a payment or a portion of the purchase price. So, say, for example, again, you believe that some of the inventory is not worth what it is on the books. What you can do is you can defer a portion of the purchase price. You say, hey, yeah, the business is worth $1 million based on cash flow, but there may be some inventory adjustment necessary. So I'm going to hold back 20%, or I'm going to hold back through a VTB for 3 years, 20%, and make sure that I transition the company correctly before I pay you the remaining portion of the value of the business. The other one is more specific to the buyer, the leverage that you take on. Now, most traditionally buyers will leverage the purchase of the business by 50 to 80% of the value of the company. So for a very clean, highly profitable business, doing a 70% debt to 30% equity buyout would make sense. But if there's a ton of risk, there's transition risk, you got to move out of the facility in 2 years' time, it doesn't make sense to carry 70, 80% of the transaction value through debt. Maybe it makes more sense to put in more equity and reduce the amount of bank leverage that you have on the balance sheet. The last one is experience, whether it comes from the buyer or it comes from the seller through rolled equity. And do you have enough? The question is, do you have enough time to learn the business so that you can get a handle on these risks? So if your level of knowledge in the sector is very high, then obviously that's mitigating some of the transition risk. But what if your level of knowledge is very low and you need to be trained correctly by the seller, and the transition is going to be a little bit more bumpy? To do that, what you can typically do is A, hire the right people around you, and B, get the seller to roll some equity. So yeah, I'll buy your business for $1 million, but I want you to hold back 20% of that through equity, so that you're a minority shareholder in the company on an ongoing basis. And so that in the future, once the transition goes through and, 3-4 years down the line, I, as the buyer, am comfortable in my new role, I will then buy out the remaining 20%. So it keeps the owner, the seller, involved in the company, and that they have skin in the game, and that they're motivated to make sure that they can help you manage the risk accordingly. So these are the 4 levers that you can pull in managing the risk level of anything that you're going to face. But the key comment is that it's almost unavoidable. You're going to face risk in any business purchase. The real way to think about it is, how can I mitigate the risk that I'm taking on and the level of risk that I'm taking on? That's the key. That's the key mentality. So now let's go into the specifics. So number 1, the key owner involvement. A very common risk that arises in the lower mid-market is key owner dependency. And this is where the owner is working full-time in the business, handling operational roles like sales, pricing, ordering, production, product idea generation, everything. And they don't have a lot of time to focus on the medium to long-term strategy of the goals, because they're focused on delivering the short term, collecting the bills, making sure that things are running correctly. And this typically is the reason why this happened is the owner either doesn't know how to delegate, isn't a very good manager, or doesn't really understand the value of investing in paying middle management and paying a VP of operations to take on some of the roles that he or she can do. Most instances, when I have clients that face this risk, I can see outside looking in that they just are too worried about letting things go. They're too worried about product quality, about turnaround time, and their mentality is, hold on, I can do it. I can do it myself. Why should I hire someone else to do it and run the risk of upsetting my customers when I can do it myself? And that's a very short-term mentality, because when they want to go and sell the company, they're faced with this risk. And then the buyer obviously reduces the value that they want to pay for the business. I'd say 10 times out of 10, not even 9 times out of 10, when there's a full management team in place and you're selling a company, you're going to get more value for it than if you're a key owner in the company. So, the risk involved with, key owner involvement is, as I mentioned, the transition risk. The suppliers and the customers are so used to dealing with the owner. The question from the buyer's perspective is, are they comfortable in doing business with you? and not picking up the phone and expecting to hear Frank's voice, but hearing your voice. Is that doable? Can you transition those customers, which generate a core portion of the value of the business? Another one is operational problems. They're typically dealt with by the owner, so there's no real knowledge around the owner to handle these problems. So what happens if you buy a business and the next day, the owner goes away, he's retired, and all of a sudden you have a customer complaint and you have no idea how to answer that customer complaint, and the staff don't know how to answer that customer complaint because it was all in the owner's head. So that's another key risk. And when you have all the processes and orders, really the processes of the company in the owner's head and nothing is documented, as it feeds back into the first one, the transition risk becomes, triple as difficult. It's just so difficult to transition a business like that. So, some questions from the buyer's perspective that you can ask the seller as you learn about the company and get through this process and address this risk is, walk me through the day to day. What do you do on a day to day basis so you can learn about their tasks and the goals that they have? Percentage wise, how do you allocate time between these things? You spend 40% of your time on production, 20% of your time on financials. I'll give you a good example. We were selling a manufacturing business where the owner spent about 90% of his time on just financial bookkeeping, invoicing, like year-end accounting. And you could just hire a CFO to do that. Why are you doing that? And that was what the buyer did, which freed them up to actually go out and seek more business and grow the company. Another key question I always ask is, how many weeks per year do you take vacation? And some owners will say, well, I haven't taken vacation in 5 years. And the reason why is they're so critical to the business. If they leave for a day, the company's going to fall apart, or things aren't going to get done and they're going to fall behind. So it's a really good proxy to see how critical they are to the company. If they're ultra critical, they will not take vacation very frequently. Whereas if they're like, oh, I've taken about 4 or 5 weeks this year, and last week we went on a 4-week vacation through Europe, there's probably enough institutional knowledge around them to transition the business correctly. Now, another question is, do customers ask to speak with you directly? Do employees require your sign off prior to making, pricing and a sale, getting it done? Because if that's the case, then employees are not taught to be thinking independently. They're highly dependent on the owner to make the final tough decision. And so that means more training is required once you come in as a new buyer. And then the last comment is, have you ever tried to hire someone? In most instances, you ask this question of the key owner, they're like, well, no, not really. And they haven't even gone through the exercise of trying to train a senior executive to take on some of these roles. So really, you as a buyer just have to try to hire someone. It's as simple as that. Now, let's talk about the second risk. When buying a business, reviewing the financial records and confirming the claims that are made by the owner through data is critical to gaining the comfort you need to invest and close on that business. If verbal claims cannot be supported by raw data, you shouldn't pay for them. It's as simple as that. So a good indicator of potential discrepancies is the financial controls and quality of the information from the business owner and the business broker. And so what poor financial controls puts at risk is potential fraud, overestimating the true cash flow of the business. I've heard this so many times. Oh, my net profit on the financials is 100K, but I collect 50K in cash. Well, how do you prove that? I'm not going to pay for that 50K and cut a check and pay 4 times that 50K because I can't prove that the cash is there, that it's actually coming in. As well, the business is exposed to potential tax liabilities. If they're misreporting or underreporting their potential profit, if there's a CRA or an IRS audit on the business, as you, the new owner, all of a sudden you have to go through the whole time ordeal of wasting the time to supply this information, and you're potentially exposed to previous unpaid tax liabilities. The other one is you can't track accurately the performance of the business. There's poor operational data, so you can't even complete your due diligence to say how many quotes did you provide, what's your gross margin targets, how do you price things. If everything's tied up in the owner's head and they don't have any financial processes and controls in place, then transitioning that function of the business becomes so much harder. And then in general, if there's poor financial controls and the internal financial data of the business is not accounted for accurately, then the banks and the investors that you as the buyer are going to reach out to get the loan, to get the equity funds to close on the deal, are also going to question the value of the business. And it will make it really hard for you to close on that deal. So, some ways to move around and address this risk is the first one, you go talk to the accountant if they have one. If they have an accountant, the first thing is, are they a CPA? Sometimes they're not even a CPA and they're signing off on financial statements because they're not up to the times. They're not keeping up to the times. There's other instances where it's just an internal bookkeeper. So you got to go reach out to the internal bookkeeper and ask them specifically what they do for the company so that you can understand where the gaps are. Is it led by an inexperienced or poor accountant, or is it more led by the ownership group and their not unwillingness to record this financial information? Another thing to ask for is, what internal software are you using? QuickBooks, some kind of pay me easy. Like, what are the systems that you're using? And I'll give you a really good example. I'm working on a printing manufacturing company right now where, the owners are literally tracking their financials on Excel. And it's almost so difficult to sell the company because every buyer, takes the information we give them at face value and then starts digging in and says, hold on a second, you don't even have a QuickBooks account? I can't even generate the interim monthly financials for the business. No, I can't buy this business. So it almost becomes unsellable, the company, because they're not tracking their information correctly. And then from the buyer's perspective, if you go through this process of buying a company with poor financial controls, 9 times out of 10, you should probably get a quality of earnings done. And I have a separate video on the channel. You can look up that one. But that's going to cost you 10, 20K to go through and individually analyze the invoices and transaction records to rebuild the financial statements. Is that a cost you're willing to incur, especially if it's a small business? If you're buying a $300,000 business, spending 10K on an accounting report is a lot. And is it even worth it? So one way you can kind of at least confirm some of the cash flows, and it's the last point here, is getting their monthly financials and getting their monthly business banking statements. So you ask for their bank account statements, and you can see the debits and credits that are coming in and out of that bank account to see what type of cash flow is coming in and out on a monthly basis. So say, for example, the annual statements show profitability, but the monthly banking statements, which are up to date because they're generated by the bank, not the business, they will show, hold on a second, the first 10 months of the year, cash outflow, net cash outflow. There's no real profit being generated, and it's all being generated in the last 2 months. And then you drill in those last 2 months and you can realize, hold on a second, the profit came from a equipment sale or it came from a one-time large sale. That's not going to happen again. So you can get at least a general sense for how the cash flows of the business perform on a month-to-month basis. So banking statements from the day-to-day banking provider is probably the best first step when you're analyzing poor financial controls. Now, what about deferring investment? So for businesses that require equipment to deliver a service or a product, CapEx is a required expense that needs to be incurred. So some owners will try to defer the cost to save some money just as they're about to sell the company. So, really it's a way to save some money, especially if, say, for example, the business generates $200,000 a year in profit, and about $100,000 of that needs to be reinvested in the company to replace some equipment. But the owner says, hold on a second, I'm selling this company next year. I'll just take the full $200,000 out of the business and kick the can down the road. Well, if you inherit outdated facilities or badly worn down equipment, all of a sudden the new buyer is at risk of not only putting up the money that they put up to buy the business, but they're putting in more money to replace the equipment that should have been delivered to them in a working condition. So this is a very common area to look out for. So you have to put in more money. That's one of the key risks. The second is you're probably going to be at a competitive disadvantage if these machines go down or if the equipment that's required to generate the profit goes down. So you not only increase the acquisition price as the new buyer, but you put yourself at a competitive disadvantage. You limit the business's ability to generate more revenues because the equipment's down. And especially if the building is leased, rent may actually increase because the landlord will come in and, obviously the landlord doesn't pay attention to the day-to-day facility state. But when a new buyer comes in, they'll walk around the facility and say, hold on a second, you as a tenant are liable for repairing the inside of this building. And the walls are cracked. This needs to be repainted. This glass needs to be replaced. Blah 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 blah. And if you deferred that investment for years and years, the landlord can hit you with a bill where they're going to justify a TMI increase in the lease because all of a sudden you, as a new buyer, look like you didn't invest in the facility, even though it was the decisions of the past owner. So that's really important. So, some of the questions that you can ask when you're touring the business up front and doing your due diligence is, and this is my favorite question, one of my favorite, is if you had $1 million today, where would you invest it in the business? And the owner, hopefully truthfully, will give you some guidance in terms of gaps in the business, areas where more money is needed to replace things. And so, if you ask that question, they say, oh, if I had $1 million, I may buy this machine, I might buy this machine, I may do this and this. Take that all down and drill down further into those areas where the owner has, guided you towards, because those are probably the areas where the least amount of money has been invested historically. And that leads to where you need to invest. And you can obviously ask the key question of whether, hey, I'm going to reduce the purchase price, or is it significant and material enough for me to turn away from this business? So other questions you can ask are, what are some pieces of equipment that have been giving you trouble? When was the roof last replaced? Are there any major building repairs that need to be done in the next few years? And what type of certifications are required in your industry from an employee perspective, from a ISO 9000 perspective in terms of quality standards? Because in most instances, those audits are done on a 2, 3, 4 year cycle. So say, for example, you need to invest to maintain quality standards. The owner sells the business while the certification is still live, but the next audit is the next year when you're the new owner of the business. And all of a sudden, there wasn't the investment in QA, there wasn't the investment in certain kind of preventative safety measures, and you find that gap. So it's really important to kind of drill down on the certifications and the auditing from external parties that the company needs to go through, and then decide whether the owner has invested sufficiently to maintain those certifications or not. Another risk is environmental issues. If the business operates in an environmentally sensitive industry like a chemical manufacturing plant, issues can arise in buying both the real estate and the operating company. So the buyer needs to factor in the potential risk of customer, municipal, and landlord disputes that arise many years down the line when they want to sell the property, or the municipality conducts an annual audit, or the customer decides, hey, you know what, I'm evaluating my suppliers and I want to audit you to make sure that you're following ESG, environmentally focused practices. So this environmental risk is a key pain point, especially in manufacturing sectors or sectors where you're dealing with hazardous chemicals. So the risks that arise are obviously the potential lawsuits, future remediation charges, especially if you're leasing a property, there's environmental damage, and the landlord comes after you as the tenant to say, hold on a second, your business caused this environmental damage, therefore you're liable for this. And obviously the value of the business will be lowered in the future. So say, for example, you rush through, try to buy a company, you didn't really evaluate the environmental risks, and then you own that company for 5 years, and then the next buyer is smart enough to say, hey, listen, I want an environmental report. You do the report, you find out it's environmentally contaminated. They'll never pay you the value that you paid for the business up front. And so it lowers the exit value of the business. And lastly, some banks are so ESG focused that they won't even finance you without a proper environmental report confirming that there's no environmental risk. So these are really important things to keep a lookout for. So the questions to ask throughout the process when you're looking to buy a business is, have you completed an environmental phase 1 or 2? Can I have those reports? What are your environmental policies today in terms of mitigating the potential risk of hazardous materials? Do you have a dedicated employee that manages these policies? How do you track the accountability of your manufacturing standards to make sure that these policies are followed? Because sometimes I've seen companies that have the policies but completely ignore them, and there's no employee dedicated to enforcing them. So it's almost like self-enforcing, which almost never works. And another question is, usually when there's an environmental issue, it's not just one property that gets affected, it's almost the neighborhood or the region. So a key question is, do you have any other neighbors that have environmentally sensitive businesses like car washes, gas stations, dry cleaning businesses, these types of things that would potentially contaminate the adjacent property, which is you? Now, risk number 5 is family members. So, for mid market businesses and family owned businesses, family members may end up covering multiple positions within the company, a VP of sales, a CFO, a VP of operations. And the challenge with that is the power dynamic shifts when the family sells the company to a new buyer because it causes a lot of unrest around the employees in terms of who's the big boss right now. Is it the family members who were shielded when they owned the company because they were the owners of the company? Do they have the same amount of power? How do they kind of internally, how do they get internally viewed? So there is, typically when I kind of speak with buyers is, if you see a lot of family members holding a lot of the key positions in the company and the desires for those family members to eventually transition out post sale, that's a ton of transition risk that you're facing. So be aware. Be aware that the dynamics going to shift, and those people are going to see their roles and the respect in the organization change, not negatively or positively, but change, and that results in disruption. So another thing that could happen is, say for example, the family member owns, or an uncle or a cousin owns a supplier or a customer to the business. How does that change when now they're not dealing with their family that they almost feel entitled to supplying or working with, right? So those are things that you need to ask for. So the key risks, especially if family members are in the company, is, do they have commercially sensitive knowledge, and can that be transitioned? As I said, if the power dynamic shifts, most family members can't cut it. I've seen this in multiple cases in my engagements where the son or the cousin says, you know what, yeah, I'd like to stay on. Yeah, dad sold the business, but I'm going to stay on and be a VP of operations. 6 months later, they hate it. It's completely different because the buyer is taking over the company and their cultural approach is different from the previous. So that obviously results in a lot of transition risk. The other thing is employee drama. Again, feeding into the transition risk comment, employees are maybe they never really liked the VP of sales, who was the son of the owner. And now that the dad's gone, they start talking behind his back, and boom, boom, boom. It's like all of a sudden, it's like just completely unnecessary drama, and you need to address it head on. Now, for a situation where a family member owns a customer or supplier, a key question or a key area of analysis for you as the buyer is to say, hey, are they offering me any preferred pricing or any preferred priority relative to other customers that they're working with? And so a great way to do that is to take the pricing received from that related party owned customer supplier and compare it against other customers and suppliers, and saying, if they're very competitive and it generates a ton of profit, that's at risk of not continuing moving forward. Because there's no real obligation from the uncle that owns the supplier in terms of buying the business. Like, say for example, we buy the business the next 2 weeks, the uncle comes out of nowhere and says, well, my pricing's being has increased, and I've always wanted to pass on a price increase, so too bad, I'm going to pass it on. Really, the uncle is not really entitled to sustaining or maintaining that preferable type arrangement. So you want to make sure that you don't get into situations where that exists, and if it does, you want to make sure that you're mitigating some of the purchase price by maybe tying a VTB to those favorable contracts. Now, some key questions to ask are, who is the decision maker within the company, and are any of those VPs or family member related type positions, do they have a lot of control within the business? Can I meet them? Can I learn about their day-to-day jobs as well? So in most instances, if you're buying the business from the father or the mother, you should also ask to meet the other family members in the company that are most likely aware of the sale anyways, so that you can get a general feel for what they do within the business. Sometimes they just hold, positions that aren't real. Like, unfortunately, that's the case where, some children, have a VP of marketing role and they just don't do anything. They're not really that critical to the business. Well, in that situation, realistically, there's not a lot of transition risk. But if the son is a VP of fabrication or a VP of production, and they're very critical to running the company, you want to make sure that you have their buy-in and that there's at least some knowledge around that person that you can lean on as the new buyer if that person ups and leaves the next day. Now, in terms of employees, the other thing that you can ask for is, and this is more of a one-on-one conversation with either the broker or the owner, if you have a good enough relationship, is you can ask them point blank, hey, what do you think? Is your son well respected by employees? Or do employees see him or her as a challenge to deal with? And try to get the owners or the seller's take on the drama or potential drama that exists in the company. Sometimes they'll completely hide it. Sometimes they'll be really honest if that's their value. It's worth at least asking the question. And then the other thing is to look for is, and this is why you always ask for the employee list, look at that person's role. So say, for example, the son holds a VP of sales role, look at what they're getting paid, the types of perks that they're getting, and compare it against the industry standard and other employees to say either they're getting grossly overpaid and they'll expect to get grossly overpaid, or they're very underpaid, which will result in an EBITDA normalization negatively. Because if they leave, you have to go out to market and hire someone that's going to be more expensive, which is just going to reduce the value of the business. So always try to compare to see how family members get paid relative to other employees in similar positions or the market in general. So customer and supplier concentration is another very common situation. A large customer makes up 20% of your sales, and that unfortunately is an uncontrollable risk that exists in a lot of businesses. It's very common, and sometimes they'll have a 40-year relationship with the business that you're buying, but nothing is contracted. It's you can't really expect the seller to try to approach the customer to try to lock them up in a contract. They've always done business like that. They're always going to do business like that. So from your perspective, it's important to understand, how dependent is that customer on the business. If the business that you're buying is critical and they're delivering a key technology, it's probably harder to leave. But if they're a commodity supplier, that customer has no real loyalty to the business. And so there may be potential transition risk there. So really, it's important to drill down on those key customers and understand how dependent they are on the business, how profitable how profit generating are they. Sometimes, key accounts have more leverage and power with the business and end up actually driving down margins for that account. Whereas in other instances, it's so critical to the business's profit that if that customer leaves, the EBITDA of the business changes fundamentally. And, you need to address that head on accordingly through structuring. Now, another key question to ask is if that customer or supplier has a personal relationship with the seller. And what that means is that, they're neighbors, they golf very frequently, they only deal directly with the seller, and this feeds into the key seller risk. You need to make sure that you address that head on and either transition that relationship accordingly or require the seller to stay on and roll some equity so that, he or she can be almost function as a relationship manager to transition the customer. Now, some questions to ask are, do you have underlying contracts in place? Who is the key point person that you're dealing with at the end customer or supplier? And get an understanding for, is it the owner or is it just an employee that has no real loyalty to the business that they're dealing with? It's just more they're ordering product from you. And how big of an account are you to them? Understand your importance to the customer or your importance to the supplier, because the more important you are to them, alternatively, they don't want to leave you either, right? So the risk gets lowered, even though they may still account for 20% of your business. And how easily are other competitors able to deliver the same service or product to that customer? So it's the whole question of substitution. Can you be substituted for someone else, or are you unique in what you're delivering? And therefore, even though they're key to your business, they're not going to leave because it's very difficult to find something similar to what you're providing to them. Now, in terms of non-competes, in a scenario where the business employs key people that are either privy to sensitive information or trade secrets, there is a risk post-sale that those loyal employees may either consider switching jobs, or join a competitor, or altogether start another company, and compete directly with this business that you're buying. So it's really important that you have papered agreements with those employees that say, A, there's a non-compete clause, or B, there's at least some non-disclosure agreements that exist. And as I mentioned, if the key employee has none of these agreements in place, then they could just decide one day to say, hey, listen, I always love working with Frank, but now that Frank is retired, I want to go and make my money and do what Frank did, which is start a company. And they'll up and leave. Or there's other situations where there's potential leaks or employees leaving and undermining the competitive position of the company and the value that you're paying for. So unlike the other things, unlike a customer concentration where it's very difficult to expect you to sign a contract with a customer to lock them in, this is one of the only risks where I would say, especially if the employees hold key information and key trade secrets, it actually may be a requirement for you as the buyer to require the seller to say, before I close on this deal, a condition to closing is that I get those key employees to re-sign non-compete agreements and non-disclosure agreements. And it may be too difficult or impossible to convince those employees to sign it, or there may be situations where through a bonus provided by the seller or the buyer, they sign those agreements and you at least protect yourself against this risk. So obviously the questions when you're drilling down into this area is, do they have NDAs? Do they have non-competes? Ask for those things. Ask for the hiring policies in the employee booklet. Typically in the employee booklet that has, vacation policies and blah, 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 there's actually one clause in there that will say something relating to IP ownership and, confidentiality and et cetera, et cetera. And funny enough, the owner never knew about it because their lawyer prepared the employee handbook, and they realized, hold on a second, everyone that signed this handbook is actually committed to IP protection. So sometimes we've been actually surprised that some employee handbooks have non-competes buried in them. And then another key question is to ask, how many employees in the last 5-10 years have left to key competitors? That's another key question, because some employees, especially if, say, for example, 2 years ago, an employee left to a key competitor, it may be actually a reason why the seller is selling, because they expect the shoe to drop. And so it's a key question for you as a buyer to ask to say, anticipate maybe there is other risk there that I'm not seeing or being told about. Now, most mid-sized businesses will have a few key employees that generate a tremendous amount of value for the owner. However, what happens is if the key staff recently either leave to go to a competing firm or start their own firm, that results in a ton of transition risk, because feeding into the past slide, there could be a potential shoe drop. There could be a situation where that competitor releases a similar product to the business that you're buying, and all of a sudden you're exposed and competing with someone that you didn't think you were going to be competing with. So you really need to get an understanding of the type of turnover, the level of turnover, and the potential risk that employees realize they're getting underpaid and leave after you buy the business. So this risk is twofold. You want to understand, A, can I get the buy-in from the employees? Do they trust me as a new buyer and want to stay on with me? And the key question there is, if they want to stay on with you, they're probably A, happy with their job and happy with their compensation. But what if, they're happy with Frank, the previous owner of the business, but they've always known they've always been underpaid, and you come in, they have no loyalty to you, and they smarten up, and their spouse says, you know what, now's the time. Leave, go find something better so that you can get paid what you deserve to get paid. So it's always important to take a look at the compensation levels of the key members of staff and compare it to the industry standards to say, yay or nay, or is this competitive? And if not, then maybe I should immediately increase that compensation so I can retain the staff. And accordingly, if I increase the compensation, then I reduce the EBITDA that I'm paying for, which is reducing the value of the business. So the other key question is, will you be sued in the future for a breach of any kind of compensation agreement? So in a lot of these small businesses, there's verbal agreements. There's an agreement that Frank promised me that every year I'd get $5,000 in a bonus, or, that I'd get, an extra 2 weeks of vacation, even though my employee agreement said 4 weeks. So you want to make sure that you kind of get everything on paper to confirm what the employees have been promised. So the key questions to ask are, what types of bonus plans, perks, and guarantees have you committed to your key staff, both verbally and contractually? can you provide the historical level of compensation you've paid and the bonus criteria that you've followed through on in paying to your key staff so that you can compare obviously their contracts relative to what they're actually getting paid. And we had this situation once where, there was a few key employees, on paper they were getting paid $100,000, but really the owner was topping them up and they were actually getting 150 a year. So you want to kind of be aware of where they're getting paid. And then the other thing is, has any key staff left in the last 5 years? Where did they go and why did they leave? So you at least have a key understanding of, the potential risk, the potential shoe drops of, key staff holding key information about the business and using it alongside a competitor. Now, when it comes to declining financial performance, there's a ton of stuff that you can talk about here. But at its core, what you want to do is you want to understand the reason behind the decline. And that may require actually either drilling down into management meetings and speaking with the day-to-day managers, or actually calling on competitors in the sector and getting a sense of where they are at. Is the decline due to general market standards or is it more specific to the company itself? And so typically you can call on a commercial lender and say, hey, listen, do you lend a lot to contracting businesses? Okay, what's happening in the contracting space right now? Are they busy? Are they not busy? Blah, blah, blah. Or you can call a competitor, obviously, not mentioning that you're looking at buying a competitor of theirs, but just generally saying, hey, listen, I'm really interested in your business. Maybe, I'd like to buy you. Like, how are you guys doing? What are you guys up to? Is it a good time? Is it a bad time in your sector? And just trying to probe and collect information from other sources and compare it relative to the business that you're looking to buy. And if you can compare and you find that both are doing the same thing, then it's probably a general market performance thing. But if the business is underperforming and everyone else in the sector is actually doing really well, then something stands out there and it's probably business specific. So, here are some risks that, in general, declining financial performance leads to. The first is if gross margins are declining, the new owner is going to have to continue to work harder and harder to deliver on the same amount of profit that they're paying for. So, it's really important that you factor in the trends of the gross margins relative to what you're paying for. The other thing is, does the business require more capital investment? Sometimes gross margins are declining because the owner hasn't invested in a new piece of technology and things are getting more and more competitive in the sector. So, it may result in the new owner putting up more money just to sustain the same level of profit, which means your net cost of buying the business increases. So you want to kind of understand, is the declining performance industry related or is it capital equipment or investment related? And in general, once declining performance hits a business, investors and banks will look at that and say, hold on a second, I'm not going to either lend to you or lend the same amount of money as you initially expected you could get from the bank. And the transition risk becomes tighter, right? You don't have the same room to make mistakes. You don't have the same amount of available profit to invest in the business to grow it. So your transition risk increases when performance is declining. So some key areas, or key questions to ask is how many jobs are you quoting and what is your win-loss percentage? So what that typically does is it drills into is revenue declining because they're not going after business or are they going after business and totally mispricing it? How are you performing any outbound marketing? Another key area of underinvestment is owners don't invest in advertising and promotion. So maybe they relied entirely on word of mouth. Things have slowed down. Their customers have sold off, or they're not as recognizable anymore as they were in the past, and they need to invest in marketing, and they are not. So drill down into, are they investing in marketing? Obviously, another thing is how many customers have you added or lost in the last few years? So you can ask for a 3 or 5 year historical breakdown of customers and track the year over year performance of accounts and ask specific questions around why these declines are happening. Is it customer related? Is it customer driven? Or is it because the business is, again, mispricing or under delivering on the promised level of service and quality that they should be delivering on? And ultimately, you take this risk of declining financial performance and you ask the seller, why are you selling the business? Is it because of this? Do you see the outlook improving at all? and you try to at least get some sort of an answer when it comes to whether this declining performance is the reason why they're selling the business. Sometimes it's not, it's just the bad timing, but other times it is. And they anticipate that more investments required, more work is required, and they're not willing to put it in. And therefore, you shouldn't pay them as much as they should get in a more clean situation. Now, the last risk, and something that's not commonly talked about, is expiring real estate leases. So, if the target business is renting space from a third party landlord and the current lease is below market or expiring soon, there will be a downwards impact on profitability in the future. You have to expect that because, yes, the historical profit is X, but I'm not paying you just on historical profit. I'm using historical profit as a proxy for what this business is worth. But if I know in the future historical profit's going to decline because I'm going to have to renegotiate my lease and current market rates are at much higher levels, why? That makes no sense. I'm not going to pay you for historical levels. I have to adjust those down accordingly. And buyers are pretty smart, but you have to make sure that you look out for this. Typically you adjust rent down, especially if the rental agreement is coming due within 1 or 2 years. If it's coming due 3, 4 years down the line, you could justify that. Hold on a second. You're paying for 4 times for the business, and the real estate renewal is 4 years down the line. Within 4 years, you're going to get the full payback of the business. So I'm actually not going to reduce my profitability. But if the real estate lease is coming due within a year's time, then you most likely will see a reduction in the value of the business because you expect future costs to increase. So it's not just about valuing the business on historical levels. It's about using historical levels as a proxy for the future profit of the business and then taking things like this and adjusting it down accordingly. That's how you value the business correctly and account for this risk. So you look at the risk over here. As I said, future profitability is going to decline. The other key question is, if there's a real estate lease agreement coming due, can I move the business? Do I need the same level of space? There is actually some rationale to saying, hey, you know what? I'm not using the space that I have today. I can move the business into a smaller location. And so the increase in the rent expense is offset by the decline in the space that I need to continue running the business. So realistically, the net impact is nothing. And so you should still pay for the historical levels of the business. But that, in most instances, is not the case. It's actually the opposite. The business has outgrown the facility. Not only is the lease rate going to increase, but you probably need more space, which is not usually factored into valuation discussions. So you as a buyer need to be pretty brutally honest about how much space you need and whether you actually need more space or less space. And then not only that, but if you had to move out, what's the cost of moving these assets? If you had a ton of massive capital equipment, press brakes or large bending equipment, and it would cost $100,000-$200,000 to move that equipment into a new facility, decommission it, and move it over. Well, all of a sudden, not only are you incurring additional ongoing future rental costs, but you're incurring an upfront one-time expense, which is fully accounted by the buyer because the move is happening in the future. So either you adjust the price accordingly for the expected cost and the increase in the rent, or you don't buy the business because it's too big of a risk for you. So some questions to ask are, how many years obviously are left in the lease? Can I see the lease agreement? Can I look at the extensions? You want to make sure that you have a clear understanding of the available extensions, the available use of the property, and how much is remaining. Have you started discussions with the landlord, especially if the lease is going to be renewed within the year or within 12 months? In most instances, the landlord has probably reached out and said, "Hey, listen, things are coming due soon. I'm just giving you some heads up, blah, blah, blah." You want to kind of understand what type of current or recent conversations have been had with the landlord. Another question is, how much are the leasehold improvements worth today? Because in most lease agreements, if you invest in leasehold improvements, they become the property of the landlord. And if you have to move the building, then you have to reinvest to replace those leasehold improvements in the new building. So that is an additional cost to you as the buyer if you were to move the building. Another question is, as I said before, how much does the facility move cost? So by touring the business, getting an understanding of the capital equipment, getting an understanding of what's movable, what's leasehold improvements, you can factor in the cost of the leasehold improvements plus the cost of the move and get a general sense of what the one-time fee is going to be and adjust down the valuation of the business accordingly. And then the last question is, if you're considering a move, where are the employees located relative to the business today? If you wanted to move the business 30 kilometers east or west, is that positive for the employees, or are employees living further away now and they may actually consider leaving the job to find something closer to home? So, when you're considering moving a facility, it's not just about the cost of the move, but it's about the potential cost of employees leaving you because you moved the facility. So these are things to consider and feed a lot into the future value of the business, but need to be priced accordingly upfront when buying the business. So to summarize, these are the 10 red flags, and I've really kind of gone down into depth. So hopefully you found a lot of value into them. But at its core, key owner involvement, poor financial controls, deferring investment, environmental issues, family members, customer supplier concentration risk, IP risk in terms of moving employees and non-competes and non-disclosure agreements, employee turnover and below market compensation and potential employee unrest, declining financial performance, and expiring real estate lease agreements are 10 common and very, very significant red flags that need to be looked out for when looking to buy a business. Whether it's a small business or a mid-market business, they all apply. So hopefully you found the video helpful. If you have any questions or concerns, comment below and I'll be able to answer them. And if you have anything that you want to more discuss personally relating to your own personal transaction, either reach out to me over LinkedIn or reach out through my website at robleecapital.com and send me a quick email. Outside of that, if you found the video helpful, please like and subscribe to the channel, and also consider signing up for the Finance Kid newsletter. The link is in the video description, and the newsletter really kind of covers common M&A topics and case studies, and will really kind of feed into the very similar content to what you've listened to here today. So thank you guys for watching, and take care. Thanks.